Welcome to the InterMarket Analysis video. This is a video that I do once a week, where the first part of this video, I go through and look at the valuation of the S&P 500. I look at it on a historical basis, and then we look at it on a forward basis. And then the next part of the video is I go through different markets outside of the S&P 500. We look at other indexes, other sectors. We even look at other markets, because sometimes we can get some insight or clues as to what's ultimately happening in the S&P 500 by looking at these other markets. This is being prepared for Monday, April 29th. The first thing is S&P 500 valuation, and we look historically first. This is based on what's called TTM, or the trailing 12 months. And you see a number of different dashed lines here that are different colors. The red line is a PE ratio of 20. When we're at 20 or above, the market is considered to be expensive. If we ever come down to the blue dashed line, that's a PE ratio of 15, and the market is considered to be fairly valued. And if we drop down to the green line, that's a PE ratio of 10, and the market is considered to be inexpensive or cheap. Well, right now, even though we've been under some pressure lately with the S&P 500, we're still well above the PE ratio of 20. I also blow that up down below to give you a better look at the distance between the price of the S&P and the PE ratio. Now, you can see that this lasts for a number of years. We don't use this to make decisions. If you tried to use this as some kind of a timing tool, you would miss a lot of the big moves in the market. But it's just something that we want to be aware of. Then we also plot this using different events that have happened going back to 1980 and what the valuations were at that time. And you can see, even after we've had some pretty significant downturns, we usually don't get very far below, or sometimes we even stay above the red dashed line of a PE ratio of 20. Then there's a different way of looking at this, which was developed by Robert Shiller. It's called the Shiller PE ratio. You may see this called PE 10 because it takes 10 years of earnings and averages them together. This is also often called CAPE, C-A-P-E. So it has a number of different ways that you can refer to it. And the latest reading that we had after Friday is it comes in at 33.86. To give us some context, we can look at a historical chart of the S&P 500 going all the way back into the 1800s. And we have a number of different events that have happened. Like here's the 1929 crash. Here's the 1987 crash. I guess that would be right here. We had the whole COVID plunge, and then where we're at right now. So we can see the context based on previous prices. Well, there's also some measurements that we can take. We had the median and the mean. Well, the median is we're a little bit under 16, and the mean is that we're a little bit over 17. So even if you take these both together, 16 to 17, we're still over double what Robert Shiller feels, according to this indicator, the valuation of the market should be. So we're twice as expensive on a historical basis. But the market doesn't do that. They look forward. They look at analysts' projections and forecasts, and then based on what they come up with, another PE ratio is then calculated. And to give it a little bit of context, the red line, that's the S&P 500. We also plot the mid caps and the small caps. Well, as of Friday's close, the forward-looking PE ratio is a little bit under 20, as stocks have been coming down and been under pressure lately. We're coming in at 19.8, so we're just under that expensive level. For the mid caps, we're at 14.9, so we're just a little bit under 15, and we're even a little bit lower with the small caps coming in at 13.9. And this is what the market uses to justify prices going higher or needing, in some sense, to come lower going forward. And fundamental folks that use fundamental analysis to determine if they want to get into a particular investment, they'll often use this kind of an approach, among other things that they use to make a decision. Another area that we look at is growth versus value. Typically, when the market's going up, when it's strong, these are growth stocks like Microsoft, Apple, NVIDIA. You want to buy those stocks at one price and then be able to sell them at a higher price at some point in the future, because they're growing companies. Other times, when the market becomes more defensive, where it looks like we're going to go sideways or even down, or if the economy is really running into some problems, then we'll see some of the smart money get out of growth stocks and they'll start to get over into value stocks. And then we compare the two with each other. First of all, we look at just a peer growth index where this is in an uptrend. Now, it has been pulling back as stocks have been under pressure, but over the last few trading sessions, this has been making a comeback, but it's still below its 50-period moving average, but it is still in an uptrend. We look at value, which seems to be holding up a little bit better right now. We're coming into potentially a weak seasonal time in May where we don't see really big declines, but we don't see advances either. And one of the hypotheses that I've come up with is that maybe some of the smart money is starting to get over into more of the value areas as we ride out the month of May. Now, I could be completely incorrect with that hypothesis, but it makes sense. And then maybe near the end of May, we'll see if growth starts to see some more favor, because on a seasonal basis, the summer months are when we start to see the growth companies actually start to do better. Then we do ratios between the two, where we have growth to value on top, where we really saw a downward move in this ratio. Well, this past week, it's starting to bounce back up. And then we look at an inverse of that same ratio, where we look at value versus growth, where it's been underperforming, it bounced back up, but then pulled back over the last few trading sessions. The reason why I show a lot of different charts, especially with growth to value, and I show the regular chart and then the inverse chart, is sometimes they're calculated in a slightly different manner. For instance, there's a little bit of an offset when we see a moving average crossover with this ratio. And sometimes there are indexes or ETFs that we look at, and we just want to make sure that we're seeing the same thing across a number of different vehicles. Here is an ETF of growth of value where it's still in an uptrend. It's kind of hard to see, but the blue line's above the red line. Even though it's been pulling back this past week, it did see a bit of a bounce. Here's an inverse of that same chart showing how value has been underperforming. It bounced up to this red line, which is a moving average, and then has been coming back down. We look at a longer term look at the peer growth versus peer value index ratio, where it's been really choppy lately, but it's still in a longer term uptrend. And then this is a little more of a blown up look in a shorter time frame, showing how value has been underperforming on a trending basis, even though it came right up to the 200-day moving average. Now it's bounced back down to the 50-day moving average. And we'll see, is it going to continue to fall? That would be more beneficial for growth stocks. If this goes back up, that would be more beneficial for value stocks. Then here's another index where we look at the ratio between the two, showing how growth has been outperforming. It came down to the moving average and has now bounced back up to the other moving average. And then we look at some ETFs with growth to value. And I've been showing these quite a bit in the daily video lately, because we came down with this ratio all the way to the 250-period moving average. And so far, we've been bouncing up off of that. And this would be more positive for the market if this continues to go up and we go further into the rainbow and have this turn back more positive. If we see this really break down, that could end up being more negative for the market. Here's an inverse of that same study where value has been underperforming. It came up almost to the, you see the little difference here? It didn't come all the way up to the 250-period moving average before it started to see some weakness. We break this down a little further by looking at small cap growth of value, where it had been breaking out, but as the market's been under pressure lately, we've seen this ratio really going down, even though it bounced up a little bit later in the week. The mid caps, which have been one of the stronger areas of the market, even after we've been going through a decline, this is in a longer term uptrend, even though the ratio between growth to value has been falling down, but it has bounced back up over the last few trading sessions. This is the one that I focus on the most. This is S&P growth to value, and showing the ratio where it's still in an uptrend. It did show some improvement, but then as the S&P has been going down, we've been seeing this ratio going down as well, but it has been improving as we saw a couple of, well, especially Friday's session, we saw a pretty solid up day. We keep an eye on inflation. where we look at a monthly chart of the CRB index, which are commodities, and we continue to be above the moving average, showing that in a long-term way of looking at this, the CRB index is in an uptrend. We also do a ratio between inflation areas versus deflation areas, and then we do a ratio where it has been bouncing back up, but we're still below a declining moving average. So right now, inflation doesn't really seem to be a problem on a long-term basis. Remember, this is a monthly chart. And we'll look at the CRB index on a daily chart, and you can see the different components that make up the CRB index, where this has been in an uptrend, even though over the last few sessions it's been going sideways. We look at the Baltic Dry Index, and my general approach to this chart is when it's going up, that tends to be more inflationary because it costs more to ship products. When this is going down, that's more deflationary. And we've been shopping around, but we're still in kind of a weakening uptrend here. Now, there's other folks that will shift this around and they'll move the S&P ahead a few months or behind a few months. And I just look at what the chart is saying right now. Some other markets that we don't really look at other than in this video, we keep an eye on aluminum, which has been going back up and is seeing an uptrend. We keep an eye on corn, which is bouncing up a little bit, but still continues to be in a downtrend. Wheat is also more or less in a downtrend, even though it's been bouncing up lately. Here is fertilizer, which is kind of the foundation of all the agricultural products. It's been going down for the most part recently. And then oil, which has a tendency to really spike up when there's tension in the Middle East. And that's what we were seeing. Well, now it's coming back down just a little bit from the high readings that we've been getting. And we need to look at the context when we keep an eye on oil. Now, oil can go up because of market forces, because companies are making more money, the oil companies. That can be beneficial for the market because that's feeding into the more positive backdrop. But when it spikes up for geopolitical reasons, that can be more negative for the market. And that's what we saw recently. Keep an eye on gas. Of course, this is in an uptrend, and you probably feel this every time you have to fill up. And then we look at diesel for trucks and trains. This has been pretty much flat recently now. It hasn't really been going up, but not really going down either. Heating oil, which is in a downtrend right now and been declining. Natural gas just seems to really be under a lot of pressure these days, as there's some regulations that are starting to come out that may prevent the use of natural gas in the future. Copper, which tends to be a barometer of the economy, we're seeing some pretty strong economic reports, and we're seeing inflation possibly coming back into the picture stronger than the market would like and stronger than the Fed would like. But when we see more strong economic growth, copper has a tendency to go up, and this is in a pretty solid uptrend. Then we look at a ratio. Copper tends to be more of a barometer for the economy, where gold is more of a hedge against insanity. Well, gold has been breaking out, but we're looking at this ratio. When this goes up, that means that copper has been underperforming gold, as gold has been under some pressure lately. Here's a longer-term chart going back to 1980. The black line is the ratio between the two, where overall copper has been underperforming gold, even though gold was not doing all that well until recently. And then I also plot a 10-year yield and a 2-year yield, where we're seeing interest rates going up. And we're wondering if we're seeing a shift in the overall economy. If you go back from 2012 to about 2015 or so, these were maybe even into 2016, they were having a tendency to not get that far apart, even though they're on different scales, and go in the same basic direction. Well, we've been seeing them really kind of diverge from each other for the last few years. Here's gold, which was really breaking out. It then was going sideways, and over the past few trading sessions has been going down, but longer term, it's still in an uptrend. And we're seeing kind of that same thing with silver, where it was really breaking out, seeing a bit of a pullback, but still in an uptrend. Then I take the closing value for gold on top. That's why you only see a line chart, and the closing value for silver, and I look at the correlation between the two. The higher this indicator is at the bottom, the more they're going in the same direction at the same time. Now, it could be up and it can be down. It just means they're moving more in tandem with each other, and we're seeing a pretty strong relationship between the two. Then we look at the gold to silver ratio on top. When this is going up, gold is outperforming. When this is going down, silver is outperforming. And then sometimes we can plot the US dollar index. Well, we always plot it, but sometimes we can get some insight by looking at the relationship between the top chart and the middle chart. Right now, they're more neutral. They're not really going in the same direction, and they're not really going in opposite directions. Here's the dollar, which has been pretty strong lately, and it's in an uptrend, and that can often pressure stocks. Here's another look where the dollar was actually breaking out above this downward sloping trend line. It did get up into the 106 area, but since has been falling into the 105s, but the high 105s. Here's the euro, which has been under some pressure against the US dollar index. And then we also plot the Japanese yen, which is in a really solid downtrend compared to the dollar. The euro's also been under some pressure. And then on the bottom is the US dollar index. Here's a breakout chart just showing the euro against the dollar, where we're below the moving averages, and we're seeing a death cross here with this particular ratio, I guess you could say, when you do a comparison. And we're seeing the euro going down, even though it's been bouncing back up lately. This would probably be more advantageous if you wanted to take a trip to Europe. You'd get a more favorable exchange rate. And then the Japanese dollar, let me back up. The Japanese yen to the US dollar has just been falling apart lately. And the British pound to the US dollar, it's still in an uptrend, but it has been seeing some weakness, but it did bounce up over the last few sessions. We look at some indexes, and I show this in the daily video. The bar chart that you see here is the S&P 500, which is a weighted index. So the bigger companies, the Magnificent Seven, they have more of an impact on the movement of the S&P. Well, to make it a little more fair, there's the equal weight index, where all stocks are treated the same. And even though this really went up on Friday, we were flat with the equal weight index. That's when the big caps, and the stronger, bigger companies, they tend to outperform, but we're not seeing a real solid disconnect at this point. Then we look at the equal weight, and then we do a ratio with the S&P 500, which is kind of an inverse of what we just looked at. When this is going down, that means that the broader market is underperforming. If this is going up, that means that the broader market is outperforming the rest of the S&P. And we've been chopping around quite a bit lately, but overall we have been declining as the mega caps have really been accounting for a lot of the strength in the market. Then we look at some other ratios. We compare the S&P 500 stocks with the CRB index, commodities. And even though stocks had come down to their 200-day moving average with this ratio, we're seeing a little bit of an improvement here. But the CRB index has also been doing well. It's still showing that stocks are outperforming, but this could be in danger if we see more strength in commodities, but then weakness in stocks. Here's an inverse of that same chart, how commodities have been underperforming, but showing some recent strength. Then we look at the NASDAQ 100, which until recently has been kind of the shining index because it has the Magnificent Seven stocks in there and a lot of high-tech companies. And we compare it with the S&P, which also has done well lately. Well, when this is really going up, that means the NASDAQ 100 is outperforming the S&P. Lately, we've been seeing some weakness, but over the last few sessions, this is starting to bounce back up. Longer term, we're still in an uptrend where the blue line is above the red line. We look at the S&P 100 and then compare it with the S&P 500. And the S&P 100 are the biggest stocks in the S&P 500, and they've been holding up pretty well, and they're actually outperforming the rest of the S&P. We look at the NASDAQ and compare it with the S&P 500. We're going sideways, but still overall, the NASDAQ has been outperforming. It did show some weakness as the market was under pressure, but over the last few sessions, it's been bouncing back. The NASDAQ 100 compared to the NASDAQ, showing that the NASDAQ 100 was outperforming, but seeing some weakness. We're still on a longer-term uptrend, but if we hang down here for very long, we might see a death cross in this ratio. Then we look at the mega caps, the really big companies, and compare it with the equal weight. And this is continuing to show that the big stocks are outperforming, even though they had been showing some recent weakness. We do a ratio between small caps and the S&P. That's the red line. When this is going down, that means small caps are underperforming. And just to give it some context, the blue line here is the S&P. We look at another ratio showing where the small caps are still in a downtrend when compared to the S&P 500. And we look at the biggest software companies where they've been showing a little bit of weakness. They actually fell below their 200-day moving average. They're still in an uptrend, but they're going to have to really see some upward movement to keep that longer term uptrend. Mega caps. This is where a lot of folks have been really focused on. And we did see some weakness. The nice thing is when these really get some power under them, they shoot the market higher. The bad thing is when we see a decline, they tend to lead the market lower. And that's what we were seeing. We're still below the 50-day moving average, but longer term, the mega caps are still outperforming. We look at the robotics and AI ETF. This is one of the fad areas, or what folks are really focused on right now. It had been pulling back, but over the last few sessions has been showing some improvement, but it's still inside of this rainbow. And then we do a ratio between the robotics and AI ETF and compare it with the tech sector. It's really not outperforming all that well. It was starting to, but then it pulled back as the market came under pressure. And we're pretty much in the middle of this rainbow right now. Then we have the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together. The transports have been going sideways, and for the most part, the utilities have been in a downtrend, but they saw some strength later in the week last week. Most of this upward trend that we're seeing is coming from the Dow itself, and it's still in an uptrend. We look at the S&P 500 and we compare it with short-term bonds, 1 to 3 years. Now, these are bonds based on price. And this is showing that for the most part, stocks have been outperforming, or the S&P has been outperforming shorter term bonds. It was pulling back as stocks were going down, but now we're seeing some improvement. And then we look at the S&P 1500, which is a broad market measure, and compare it with short-term bonds, 1 to 3 years based on price. Also seeing some weakness, but lately has been bouncing back up. We look at another broad market measure and compare it with a little further out bonds based on 3 to 7 years. This shows that the broad market has been outperforming, saw some weakness, came down to this moving average, and now has been showing some improvement. Then we have a total US stock ETF, which is the biggest ETF that I know of because it has 2,651 stocks in it. I know there's the Wilshire 5,000, but it's been decades since it actually had 5,000 stocks in it. This gives us a really good idea on a very broad basis of what stocks are doing. And they are in an uptrend, but they also saw some weakness. They're trying to make a run back up their 50-day moving average. We look at low volatility stocks, which are in an uptrend when you look at them all by themselves. And these are stocks that folks tend to get into when they're concerned about a market decline. This is more of a defensive type of play. But when you compare it to the performance of the S&P 500, the low volatility ETF continues to underperform. Now, as the S&P was going down, we saw this going up, but now it's starting to drop down with this ratio. We look at the tech sector, which has been the real darling sector, and compare it with bonds, where for the most part, the tech sector has been outperforming the price of bonds until we ran into some weakness, but now we could be seeing an improvement here. Then some other stocks, and I show this in the daily video too. This is an advanced decline line studies across multiple indexes. On top, we have the NYSE Just Common Stock, and we're just a little bit above the moving average. We're right on the moving average with the S&P. We're right about on the moving average with the mid caps, and we're showing a bit of an improvement, but we're still below the moving average with the small caps. And then we look at Dow theory. And the basic idea behind traditional Dow theory is we saw a recent all-time high with the Dow. To make that more confident, we would also want to see a new all-time high with the transports, and we've not seen that. So as of right now, this is a Dow theory non-confirmation. Utilities have been chopping around, but lately they've been seeing some strength. And then we look at the transports all by themselves. So they pretty much have been going sideways. They saw some weakness, and they're coming down just a little bit, but trying to show a bit of a bounce lately. And then we can do a ratio between the transports and the S&P. When this is going down, that means the transports are really underperforming. And in more solid environments, we want to see this ratio going up. But lately, we've been seeing it going down. We do another ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming the transports. And then we do a relationship between the S&P on top and the transports in the middle. and their relationship is almost neutral right now. When we get a really high reading here, that means they're going in the same direction at the same time, and they're not doing that right now. Then we are open to the idea of maybe Dow theory is a little outdated. I still look at it, still have used it for decades. But instead of using the Dow to measure the stock market, because that's only 30 stocks, why not consider using the S&P 500? Maybe that's a better representation of the US economy. And then down below, instead of using the transports, because not everybody travels by train anymore, and there's more than just trains in the transports, but we're more of a tech-based society now. So why not substitute the S&P for the Dow and the NASDAQ for the transports? And we see where we did kind of break out a little bit here, but we're not really seeing any divergences right now, as both have been under weakness, but lately they've been bouncing back. Then this is a little even further deviation from traditional Dow theory. Instead of using the S&P, why not use the S&P equal weight index, where all stocks are treated the same, and compare that not with the whole NASDAQ, but the NASDAQ 100, but an equal weight version of the NASDAQ 100. And that's what we're seeing here, where we're still staying above the previous high with the equal weight. We've actually dropped down below the previous high with the QQQ equal weight ETF. So this is showing a bit of a negative divergence. Here's the Wilshire 5000, which has way less than 5,000 stocks. This is another broad market measure that we look at. And I stopped using it for a while because it changed its symbol and it got kind of reworked. Well, lately I've kind of reincorporated that into the videos, where we're still in an uptrend on a broader term basis, but we're below the 50-day moving average. It would turn more positive if we could actually get above the 50-day moving average again. The FANG index, Facebook, Apple, Amazon, Netflix, Google, NVIDIA is in there somewhere too, and a lot of other big companies. This had been showing some weakness as the market was under pressure. We're now coming back up to the 50-day moving average. We're still in a longer-term uptrend with the blue line above the red line. It would be even more positive if we could break above the moving average. And then if we do start to see some weakness, I have some lines on here that may end up providing some kind of support if we fall. ARK, which is a very popular ETF, a lot of people got into this, and then it really started to take a dive. It really didn't participate in the upward move that we've seen in the rest of the market, but it did seem to participate in the downward move that we were going through. And it was up in Friday's session, but now it's below its 200-day moving average. However, the blue moving average, that's a 50-period moving average, is still above the red line, which is a 200-day moving average. So it's still in a longer-term uptrend. And then we look at a monthly chart of the S&P 500, and then we look at some global stocks based in Europe, Australia, Asia, and the Far East. When this is going up, that means the S&P 500 is outperforming, and it's above an advancing moving average. So this is still looking okay, even after some weakness. But remember, this is a monthly chart, so it takes a long time for these to develop. We also put a momentum oscillator down below, the PPO, where it's flattening out, but it still is above zero, and we would default to positive for that. Then we look at bonds. These are bonds based on price. We have a total bond ETF where they have come down to their 200-day moving average. They're still in an uptrend, but we're going to need to see this really bounce up based on price, which would bring interest rates down and give more support to stocks if this is going to keep its more positive trend. There's a world bond index where it's been chopping all over the place. And believe it or not, the blue line's still above the red line. But if we stay below both of these lines, we could see a death cross with this index. We look at a monthly chart of stocks to bonds showing as this is going up, that means on a long-term basis, stocks are outperforming bonds. Here's a daily chart with an inverse of that showing how bonds are underperforming stocks. Here's high yield corporate bonds. We also may know them as junk bonds. These are just coming off of setting recent all-time highs. They did see some weakness, but they're coming back up to their 50-day moving average. These are investment grade bonds. They're much more conservative, and a lot of these would be like older companies and government bonds here. They have a long ways to go to get back to their all-time high. They are in an uptrend, but as interest rates have been going up, these prices have been going down, but we may find some support at this 200-day moving average. Then we look at riskier bonds, which are junk bonds, and we compare them with more conservative bonds. And this is really continuing to go up, maybe meaning that folks are favoring the riskier bonds. They want the higher yield and they're willing to assume that risk. Now, if we start to see this ratio going down, that means folks are getting out of the riskier bonds and jumping into more of the conservative bonds, thinking that interest rates have topped out and they're going to come down, because treasury bonds are considered to be very safe, where junk bonds can be very risky. And we look at some correlation between stocks and bonds. Right now, if we're getting a high reading, that means they're going in the same direction. If we're getting a low reading, they're going in opposite directions. And then I have this area right in here where it's just showing that the correlation is neutral. And we look at the Dow Jones Corporate Bond Index, which is still in an uptrend, seeing some weakness though, and not really holding up based on price, as other bonds have been under pressure based on price as well. We look at a Fibonacci study with the 10-year yield. We're wondering, are we going to make a run for this 5% that we hit back last in October? Well, we continue to go up overall, and that may end up happening at some point. And here's a long-term chart going back to 1980, and we're seeing a general shift in the interest rate environment. For 40 years, we saw a series of lower highs and lower lows. Now we're starting to see interest rates really going up, and we might be getting back into what would be a normal before this 40-year period, where we tend to see higher interest rates. This is a chart that I've been showing for months. The takeaway from this is when we get really low readings like this, and this was a number of months ago when this happened, this was something negative. We had the Euro crisis back in 2011. Then we had the COVID crash. Of course, that was negative for stocks and bonds. But then we hit a bottom here when the market started to adopt this Goldilocks attitude that there's going to be a soft landing, that the Fed's going to be cutting interest rates. Well, that's come in, gone away many times. But the takeaway from this is considered to be positive for the market, where these other two events were considered to be negative. So we're waiting to see if something negative is going to develop. Here's the 30-year yield, which continues to go up as well. And then we look at the S&P 500 and compare it with the 10-year yield, where the S&P had been outperforming, even though it's going sideways. It's been in an uptrend, but lately, as stocks have been under pressure, we've been seeing this coming down. And then we look at 3 to 7 year bonds and compare it with stocks. This is kind of an inverse of comparing stocks to bonds. This is comparing bonds to stocks. And so this has been going down as bonds have been underperforming. As we hit some difficult times with the S&P, this started to go back up. But over the last few days, stocks have been going up. So we're seeing this ratio coming back down. Junk bonds, which tend to follow the stock market, they came down and dropped below their 50-day moving average, and they're trying to make a run back up to that moving average. We look at a ratio between junk bonds, riskier bonds, and bonds, more conservative. And when this is going up, that just means that junk bonds are outperforming because folks are preferring to take on the risk in order to get a higher yield. If we see this coming down, that means that interest rates may have topped out and folks are shifting from riskier bonds back over to more conservative bonds. Here is the 7 to 10 year bond just based on price. We're still in an uptrend, but we're falling below both the 50 and 200-day moving averages. The RSI is below 50 and the momentum continues to be negative. Here's a daily chart of the different maturities. And just by glancing at this, you can see where interest rates continue to go up for the most part. Then we look at a weekly chart internationally, where the US has the highest rates, followed by UK rates, and then German rates, and then Japanese rates. And they've all been going up lately. This is a kind of a new index on top. This is the MOVE index, which tries to measure the volatility of bonds. It's only been around a few years, so it's hard to do a lot of historical testing on this. Down below, we have the VIX, which measures the volatility of stocks, and we see that there's a pretty high correlation. Now, the correlation is not necessarily between price. The correlation measures here of the volatility, as bonds have been under pressure, and for the most part, stocks have been under pressure, and volatility tends to pick up when that happens, and that's why we're seeing a pretty strong correlated relationship here. And we look at a monthly chart of the price of the 30-year bond ETF. That's been going down, and it's below the moving average as bonds have been under pressure. On the bottom, we compared the 30-year bond with the CRB ratio, showing that bonds continue to outperform longer term, even though the CRB has been making a comeback. We look at different sectors, and I changed this a month or two ago, where first there's 11 sectors that make up the S&P. First, I look at a chart of just the sector itself, and then the chart after this will compare it to the S&P 500. Materials are in an uptrend, even though they've been pulling back lately. And when you compare it to the S&P, they've been underperforming. As the market was seeing a little bit of an improvement here with this ratio, lately it's been falling back and it's still in a downtrend. The communication sector, this has been one of the stronger areas. See the big gap down that we saw? Well, then we saw a gap up on Friday. We've come back up to the 50-day moving average. The blue line is above the red line, so we're still in an uptrend. And when we compare it to the S&P, it's continuing to be one of the stronger areas of the market, even though it did show some weakness recently. Here's energy, which is in an uptrend. It's really been going up, but lately pulling back and dealing also with this 50-day moving average. But when you compare it to the S&P 500, it is showing a lot of improvement, but we're still in a longer-term downtrend. Here's the financials, which have been holding up fairly well by themselves. They're a little bit above their 50-day moving average and in an uptrend. And we're still in an uptrend when compared to the S&P, but we really saw the decline over the last few trading sessions in this ratio. Industrials, which are coming back down and dealing with their 50-day moving average, but they are showing more of an uptrend when compared to the S&P 500. This has been a stronger area in 2024. Tech sector, which is still in an uptrend, saw some weakness, still in between both of these moving averages. And it's still in an uptrend. It's still outperforming the S&P, even though it did pull back as the market was going under some pressure right about at the beginning of March. That's when we saw this ratio starting to fall. If this can go back up, that would be more positive for the market. Staples, things that you have to have no matter what's going on in the economy, and these tend to be more defensive. We've been in a really solid uptrend here. We did see a pullback, but now it's starting to go back up and getting pretty close to its previous all-time high. But when you compare it to the S&P, it's been underperforming. Now it bounced back up as the S&P was going down, but now that the S&P has bounced up, this ratio is also going down. We look at real estate, which by itself has been hanging in there. It's still in an uptrend, even though it's been pretty choppy. When interest rates are going up and housing prices are going up, that really puts pressure on the real estate sector. And when interest rates are going down, that tends to be more beneficial for the real estate sector. But when we compare it to the S&P, it continues to really underperform. Utilities, in an uptrend when you look at them by themselves, but when you compare them to the S&P, we did come back up to the 200-day moving average with this ratio, but now we're starting to bounce back down. And then we look at another ratio, the S&P to utilities. When this is going up, typically the S&P is going up. When this is going down, typically the S&P is going down. Healthcare, another defensive area, which is still in an uptrend, even though it's been falling below its 50-day moving average. But when we compare it to the S&P 500, it continues to really underperform. Discretionary, these are the things that make life fun. This continues to be in an uptrend. It came all the way down to its 200-day moving average, found some support here, and has been bouncing back up. But it continues to underperform when compared to the rest of the S&P. Now, earlier in 2023, this was a stronger performing area and was really giving some strength to the market. The fact that this is lagging behind has been putting some pressure on the market. Semiconductors, a stronger area in an uptrend. Fell below its 50-day moving average, now trying to come back up to its 50-day moving average. And then we look at the energy sector and compare it with the tech sector, showing that energy's been underperforming, but lately bouncing up. If this stays above both of these lines, we might see a golden cross showing that energy is outperforming tech on a ratio basis. We look at growth stocks and compare them with bonds, showing that even with the weakness, stocks still continue to outperform bonds as interest rates have been going back up. We look at the tech sector and compare it with the 10-year yield, showing how tech sector has been outperforming, but as interest rates go up, because these companies have to borrow a lot too, we did see some weakness, but we're still in a longer-term uptrend. Then here's an inverse of that same chart showing how the 10-year yield had been underperforming, but seeing some recent strength. Discretionary versus staples. This had been going up, showing discretionary is outperforming, but we are seeing some weakness. And a lot of this weakness is coming from Tesla. If this could really get some legs and continue to go higher, that would be more positive for the market. And then here's an inverse of that same chart showing how staples are underperforming. If we stay above these lines, we might see a golden cross with this ratio. Gold compared to the S&P, it's still in a longer term downtrend, even though gold has been going up. And we might see a golden cross here if gold holds on to the strong prices that it has. But if the S&P really starts to go back up, it could turn this ratio back down. We look at gold compared to the dollar, where it had broken out above both of these trend lines lately. As gold's been under weakness, we've seen a pullback with this ratio. High leverage loans, and I like to point this out, these are very risky loans. They're very highly collateralized. That's what high leverage means. And the folks that get into this ETF, they're not stupid. They tend to be very well versed on what's going on in the market. And if we were getting ready to see some real problems, this ETF would not continue to go up. It came down close to its 50-day moving average, but with the bounce that we saw, it's now bouncing up above its moving average, and it's been in a long-term uptrend ever since the beginning of 2023. The NYSE composite did come down and is challenging its 50-day moving average, but it's still in an uptrend. This is another broad market measure. We look at all stocks in the US and internationally. We fell below the 50-day moving average. Now we're trying to make a comeback to that moving average. Here's emerging markets, which pretty much are treading sideways, and they're still continuing to be in an overall uptrend. We want to keep an eye on the Japanese Nikkei just because it set recent all-time highs, but lately it's been falling back down. We look at micro caps, very small companies. They continue to be in an uptrend. They came down close to their 200-day moving average, but have been bouncing up slightly from there. And then we do a home builders study. We're not really seeing anything here. The top part is the S&P. The middle area is the home builders ETF. And then I have a correlation along the bottom. When we really pay attention to this is when we see the correlation really going in opposite directions. Right now, they're having a tendency to go in the same direction. So we're not really getting any insight from this chart. Bitcoin, which topped out at about 73,800, it's been under some pressure, dropping below its 50-day moving average, but it's still in a longer-term uptrend. Then we look at internationally using a different type of oscillator called a KST, which takes longer to move. We're actually seeing a little bit of an improvement, and it's turning up in China. We're still declining in the emerging markets, declining in Europe, declining in Japan, and still declining in the US. Then we have an intermarket analysis chart here showing that oil is doing the best, then gold. Stocks had fallen under the dollar, but now they've reclaimed that. And then the green line is the dollar, or if we look at the bonds based on price, they're negative going back to the beginning of the year. Some correlations. We look at the S&P and compare it with the dollar, where we're just coming out of being more neutral. As this goes down, that means the dollar and the S&P are having a slight tendency to go in opposite directions. Then we look at the S&P 500 and compare it with oil, where when things were really erupting in the Middle East, we saw them going in opposite directions. Oil would go up, and that would put pressure on stocks. Now we're seeing them having more of a tendency to go in the same direction. So maybe this is showing a little more stability right now. We compare the S&P 500 with the 10-year yield. After going into neutral territory, they're having a slight tendency to go in the same direction. We're also still pretty much neutral when we compare the 10-year yield with tech, but this has been going up. So if this keeps rising, that means the 10-year yield and tech are both going up, which usually goes against what happens in a more healthy environment. Then we look at the S&P 500, compare it with the 2-year yield. This is starting to go back into a neutral reading. And we take a long-term look at some secular, that can mean decades, versus cyclical, which is something that may last for months or years. My personal opinion is we've been in a long-term secular uptrend for well over 20 years now. What we saw in 2022 was a cyclical bear market. Now, there's others that would disagree with that. We look at a monthly chart of the NYSE composite. Even though it's declining, it's still above the moving average, and the red line, which is the moving average, continues to go up. The Copic curve, which is a momentum oscillator, it's continuing to go up. Here's a daily chart of the NYSE, and then down below we have a different indicator. This is the NYSE record high percent index. When this is going up, that's more positive. Now with the recent weakness that we've seen, this has come down slightly. And then we look at the S&P 500 on a monthly chart. On top, we're above the moving average, so that's positive. And we also put a momentum oscillator here. It's rolling over a bit, but it still continues to be positive. And then we do a ratio between the S&P 500 and commodities longer term. When this is going up, that means stocks are outperforming commodities on a monthly chart. And then we look at the S&P 500, look at another monthly chart, compare it with the global index. When this is going up and above the red line and everything's going higher, that means that the S&P is outperforming global stocks. This is also a monthly chart, and the KST and the moving average, which is another momentum oscillator, they're pretty much on top of each other right now. Then at the very end, I take a list and I make all the positive things on one list. And my definition of positive is when the 50-period simple moving average is above the 200-period simple moving average. And this list is quite long right now. That's why the type is so small here. Growth is in an uptrend, value is in an uptrend, copper's in an uptrend, the British pound compared to the dollar, gold, silver, the dollar's in an uptrend, the CRB index, the big software companies, the mega caps, the FANG index, even ARK, it's seeing some weakness, but it's still in an uptrend. The low volatility ETF, when you look at it by itself, it's underperforming when we compare it to the S&P 500. Staples are in an uptrend, the Dow Jones Composite Average, all the bonds that we look at based on price, some of them are showing some weakness, but the longer term trends are still hanging on for right now based on price. The tech sector, as well as semiconductors, high leverage loans, the Dow, the NYSE Composite, and the Wilshire, those are two different broad market measures. And then that long-term ETF, or the big ETF also, because I like to compare the S&P to the broad market itself. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps. Even though small caps have been a real disappointment, they're still in a longer term uptrend. All stocks looking internationally as well as stocks in the US, emerging markets, even though they've been going sideways, and Bitcoin continues to be in an uptrend. Now our list for negative is pretty short. That's when the 50-period simple moving average drops below the 200-day simple moving average. And we have the Japanese yen compared to the US dollar and the euro compared to the US dollar. And that's it. It's negative for right now. So thank you. I really hope you found this helpful. This is not necessarily meant to be a standalone video. The daily video is the foundation of what I do. And then I do a weekly video, and then there'll be other videos that I do after this. So I hope that you have a really good weekend, and I will talk to you in the next video.